10 major banks are now collapsing. The collapse of Silicon Valley Bank and Signature Bank earlier this year sparked a crisis of confidence in the U.S. banking sector, leading to a run on deposits at a host of regional banks, despite authorities launching emergency measures to shore up confidence. Federal Reserve Survey data released last week showed U.S. banks reported tighter credit standards and weaker loan demand from both businesses and consumers during the second quarter. Moody's cut the ratings of 10 banks by one notch and placed 6 banking giants, including Bank of New York, Mellon, U.S. Bancorp, State Street, and Truist Financial on review for potential downgrades. Rating agency peer Fitch has downgraded the United States by a notch to AA+ due to financial deterioration over the next 3 years and repeated down-to-the-wire debt ceiling negotiations. All of this is pointing towards one thing only. Major banks in the U.S. are on the brink of collapse. We put enormous effort into producing data-driven content to show you what's fake and what's real. Subscribe and comment to The Final Economy. Ally Financial Incorporated, operating as a digital bank and having a significant auto lending operation, primarily for General Motors and Stellantis auto dealers, Ally Financial is exposed to multiple risks that are impacting its stability. The institution's balance sheet is under pressure due to rising interest rates, which affects its loan portfolios and profitability. Additionally, Ally Financial's exposure to risky assets, combined with a slowdown in its auto lending business, has raised concerns about the quality of its assets. Several factors contribute to the institution's vulnerability. The growth in deposits amid rising interest payments is creating financial strain. Furthermore, its substantial investments are yielding less than the current rates offered to depositors, impacting its revenue generation. The fact that more auto loans are going underwater and delinquency rates are rising raises doubts about the credit quality of its borrowers. Ally Financial's high exposure to the auto lending market, along with its challenges in managing interest rate dynamics and maintaining credit quality, places it in a precarious position. Comerica. The institution is one of 6 banks that credit ratings firm Moody's placed on watch for a potential downgrade. This situation is indicative of cracks appearing in Comerica's financial foundation. Several factors contribute to Comerica's vulnerability. The bank has a relatively high amount of unrealized securities, and its lower level of capitalization, along with a greater share of deposits above the FDIC's insurance threshold, places it at risk of facing liquidity issues. Moody senior analyst Megan Fox highlights the possibility that Comerica could be sensitive to large withdrawals from depositors, which might force the bank to sell its assets to manage the situation. Comerica's financial flexibility is impaired due to its exposure to construction and development loans, which have been a source of elevated credit costs. Additionally, its reliance on market funding and its potential vulnerability to rapid withdrawals further raise concerns about its financial health. The erosion of its deposit base and the impact of quantitative tightening, where the Federal Reserve reduces its balance sheet, are contributing to the challenges faced by Comerica. KeyCorp. The Cleveland, Ohio-based institution provides retail and commercial banking services, student loan refinancing, and mortgage services. Delinquencies across various loan types are trending upward at Key Bank, impacting its profitability. The bank's loan delinquencies are contributing to lower profits and reduced stock value. For example, its quarterly profit fell by a significant 50%, and provisions for credit losses surged surged by 271%, indicating deteriorating credit quality and increased loan defaults. One of the significant issues facing KeyBank is its exposure to student loans, which have seen rising delinquencies and defaults. Additionally, the bank's net interest income dropped, and its net income from continuing operations declined significantly year over year. As borrowing costs continue to rise, KeyBank is anticipating further loan losses, particularly in its mortgage lending portfolio. This combination of rising delinquencies, declining profitability, and increased loan losses is putting KeyBank at risk of financial stress. Pacific Premier Bancorp, headquartered in Irvine, California, this is a full-service commercial bank with branches in several states. The bank's expenses have been increasing significantly, and this trend is exacerbated by its exposure to credit losses. While the company reported a provision expense of $2.8 million in 2022, this year has seen expenses over 5 times higher, reaching $14.6 million. This substantial increase in provision expenses indicates deteriorating asset quality and increasing credit risks. Pacific Premier Bank's focus on loans and unfunded commitments has further added to its financial strain. The decline in asset quality and increased credit risks are creating significant challenges for the bank's profitability and financial stability. The bank's limited preparedness to cover potential profit losses is a significant risk factor. The combination of these challenges and the lack of sufficient buffers to absorb potential losses makes Pacific Premier Bancorp particularly vulnerable. Analysts and industry experts are closely monitoring the bank's financial situation, with concerns about its ability to manage its asset quality and navigate the evolving economic landscape. Popular Bank, a financial services provider in the United States, Puerto Rico, and the Virgin Islands, is facing a critical situation that involves not only financial challenges, but also accusations of fraud by government agencies. The bank's handling of Paycheck Protection Program (PPP) loans, despite detecting signs of potential fraud, has come under scrutiny. This has led to accusations of ineffective controls, violations of internal Bank Secrecy Act protocols, and unsafe practices by government regulatory bodies. Popular Bank's actions in processing and funding PPP loans have resulted in financial losses for the bank and taxpayer money, further impacting its financial health. Additionally, Popular Bank's financial performance is concerning. It has suffered a decline in revenue and a 7% drop in deposits. These declining financial metrics are significant red flags, suggesting potential instability and challenges in maintaining profitability. The bank's involvement in PPP loan-related controversies, coupled with its declining revenue and deposit base, creates an environment of uncertainty and potential financial stress. Zions Bank Corporation. This banking giant, headquartered in Salt Lake City, Utah, is facing a range of critical challenges that are impacting its financial stability and resilience. The bank's recent performance and underlying risk factors have led to growing concerns about its ability to weather ongoing economic challenges. One of the key issues affecting Zions Bank Corporation is its exposure to credit risks. The bank's construction and development portfolio has experienced significant deterioration, leading to heightened credit costs. This elevated credit risk, coupled with valuation losses and securities impairment, is contributing to a decline in the bank's financial health. The impact of these challenges is reflected in the bank's stock market value, which has fallen by 40%. This decline in market value has weakened Zion Bank Corporation's financial flexibility, making it more vulnerable to financial pressures. The recent downgrade in the bank's credit ratings further underscores its vulnerabilities. The downgrade reflects a deterioration in Zion Bancorporation's financial strength and a reduced capacity to improve its profitability. Eastern Bank, the Boston and Massachusetts-based bank, is facing a complex situation that involves both financial and operational challenges. The bank's recent performance and strategic decisions have raised concern about its stability and ability to manage risks effectively. Eastern Bank's financial indicators have shown signs of stress. Its bad loan ratio, which represents loans that may not be recoverable, is nearly twice the normal rate. This indicates that a significant portion of the bank's loans is at risk of non-payment, potentially leading to write-offs that impact the bank's profits. The bank's recent decision to sell a portion of its bond portfolio to reposition its balance sheet has resulted in substantial losses. While this strategic move was necessary, it has added to the financial strain that Eastern Bank is facing. Moreover, the bank's deposit base has been decreasing, leading to higher deposit costs. With a significant portion of its deposit base in low-cost or zero-cost checking accounts, this decline in deposits is affecting Eastern Bank's profitability. Silvergate Capital. Based in La Jolla, California, this bank has faced a significant downturn and a series of challenges that have led to its current state of bankruptcy and cessation of operations. The collapse of the cryptocurrency exchange FTX in 2022 significantly impacted Silvergate's financial health and stability. As a bank that catered to digital asset customers, Silvergate experienced a substantial decline in total deposits from these customers, from $11.9 billion to $3.8 billion through its fourth quarter. This dramatic decrease in deposits, combined with significant losses incurred due to the downfall of FTX, has resulted in the bank's decision to file for bankruptcy and wind down its operations. Silvergate's bankruptcy filing and the subsequent process of addressing its final payment obligations have left the bank in a state of uncertainty. The bank's focus on digital assets and its association with the crypto market's volatility exposed it to risks that proved to be detrimental. While there is no precise timeline available for the completion of the repayment process, the collapse of Silvergate Capital underscores the challenges and risks associated with digital asset banking and the broader cryptocurrency ecosystem. This situation serves as a cautionary tale in an industry characterized by rapid changes and potential regulatory uncertainties. Home Street Bank. Home Street's financial indicators reflect a difficult environment. Their earnings per share came in below investor expectations, indicating challenges in maintaining profitability. The bank's revenue miss of around $60 million and a declining deposit base signal potential difficulties in generating income. A significant factor impacting Home Street Bank's financial stability is its exposure to risky assets, particularly loans that may not be recoverable. The bank's high bad loan ratio, nearly twice the normal rate, suggests an elevated risk of non-payment and potential write-offs that affect its profitability. The bank's decision to sell a portion of its bond portfolio to reposition its balance sheet has resulted in substantial losses. While this move was necessary to manage risk, it has contributed to the financial strain the bank is facing. Overall, the combination of declining profitability, high exposure to risky assets, and losses from balance sheet repositioning paints a challenging picture for Home Street Bank. Citizens Financial Group. With a market capitalization of $16 billion, this bank is grappling with a complex set of challenges that have raised concerns about its financial stability and performance. The bank's recent performance and exposure to various risks are contributing to its vulnerability in the current economic landscape. One of the key issues affecting Citizens Financial Group is its exposure to credit risks. The bank predicts that over 55% of its loans are at risk of non-payment, signaling a significant portion of its loans facing potential default. This elevated credit risk could lead to a substantial impact on the bank's profitability and financial health. Citizens Financial Group's financial indicators show signs of stress. The bank suffered financial losses amounting to $310 million in the second quarter, which further raises questions about its ability to manage profitability and navigate challenges effectively. Multiple banks in the United States are facing a critical situation, with factors like rising interest rates, souring loans, lower deposit rates, and falling profits contributing to their vulnerability. The collapse of banks like Silicon Valley Bank, Signature Bank, Credit Suisse, and First Republic has initiated a concerning trend. Regional banks are at a particular risk due to aggressive interest rate hikes by the Federal Reserve. Some banks have lost substantial market capitalization this year, and various institutions are potentially on the brink of failure. The challenges include high exposure to risky assets, increased delinquencies, and operational risks. If these vulnerable banks face a run, it could trigger a crisis affecting both the banking sector and the broader economy.